Hey everyone, Kevin here. So many of you know that I'm a real estate broker and real estate investor, and I love sharing real estate with you on this channel. Well, today I want to give you a little bit of an update as to what I think is happening in the market and some trends that are changing and whether or not we're going to see a foreclosure wave after this sort of pandemic comes to an end, what we expect for pricing going forward, and how I'm investing during this time, as well as some options for you. So let's get right into it. The first thing that is useful to know is, as expected, we were talking about this back in March, construction activity has substantially contracted. Now, I imagine this will come back, but we see new building permits down about 21% and housing starts down about 30%. This is a substantial sort of decline in construction activity, which makes sense for remodeling. Less people want folks in their homes, less people are interested in adding on during a pandemic, though we might see that pick up after the pandemic. And we know that new construction home builders do not like betting on projects that cost them hundreds of millions of dollars in one location when the market is really uncertain. We saw the same kind of pullback back in 2018 when the real estate market just tanked like 12% like that, thanks to Jerome Powell bumping up interest rates. As soon as that happened, what do you think happened with home builder starts right after that? They plummeted. Home builders are very reactive to what's going on in the market. As soon as there's uncertainty for the horizon over the next 2 to 3 years, home builders wait. The interesting thing about this is less homes that are built actually can tend to constrain supply, especially in areas where that supply is needed most, like coastal regions where prices seem to continue to go up. Keep that in mind. At the same time as this is happening in the construction industry and the new construction home builder market, we see that mortgage applications to buy homes increased about 6%. So we're seeing this really interesting move of buyers coming back to the real estate market in very much like an odd V-shaped recovery for real estate in terms of buying demand. But we know this is short term. We know that right now, most real estate is looking backwards. When we look at data today, we're really looking at escrows from April. And when we look at the data across the country, a lot of our sales data is pretty flat since the beginning of the year. We've given up a lot of the gains from January and February. So a lot of sellers that are putting up properties on the market today are like, ha, I get to use comps from January and February and sell my property for more money. And buyers are like, I'm okay with that because rates are up. But is this all like Fugazi temporary magic? And are we just setting ourselves up for a big foreclosure crisis to come when this pandemic ends? Well, in order to answer that, we have to understand what kind of crisis we're in and how the government responds to this and how the Federal Reserve responds to this, which the government has a mandate over the Federal Reserve, right? So I'll just say government going forward so it's simpler. The most important thing to realize is the great financial crisis was a financial crisis. 2008 to 2011, a financial crisis. Banks froze, lending froze, credit froze, foreclosures came about because of crappy underwriting standards, which basically mean people were getting terrible loans. People were getting loans where basically every month they would owe more on the property. That's crazy. And then on top of that, variable rate interest loans, like the rate can go up instead of just having a fixed rate 30-year mortgage where your payment is consistent for 30 years. And of course, we had borrowers getting loans who were never qualified for some of these loans in the first place. We know that. And all of that led and contributed to this great financial crisis that we had in 08 and 09. And real estate prices really started falling in 2005. Imagine that. You started seeing real estate prices slowly trickle down from 2005 all the way down through 2011. But you didn't really see the big drop until like 2009 when that foreclosure crisis came. So then we try to align ourselves. Okay, well, if we're seeing a flattening of real estate prices now, we've got kind of mixed data. Okay, more buyers are coming in, but data's kind of flattening. What do we expect is going to happen? Are we in a 2005 where prices are at the peak? We're starting to get some of that shaky footing. And is this the start of a big plummet? Well, remember, the last crash was a financial crisis. This crisis is a health crisis that has turned into an economic crisis. And that's a very important distinction Because right now, we're not, as crappy as the markets seem, right? As crappy as the job market seems, the labor conditions, companies with layoffs, and this whole work from home movement changing things, and we'll talk about those trends in just a moment. But as crappy as those things are, our economy is suffering. Our economy is frozen. But our banks are not, which is weird, right? The banking system is fluid. The banking system is working. The credit markets are working. You can get a mortgage. You can get credit lines. You might not be able to get a credit line everywhere anymore, but you can still get home equity lines of credit. You can still draw on debt. Most people didn't have their loans frozen or like they had in 2009 or their credit lines locked up, right? We're not seeing that. We're not seeing that because we're not in a financial crisis. And who's making sure that we don't go into a financial crisis? The government, and by mandate, the Fed. The Fed is suggesting, and this is their wording, we do not want this economic crisis to turn into a financial crisis, and we will do everything in our power to prevent that. If you listen to what they're saying, they're literally telling us they will do whatever it takes to make sure that we do not have a 2009 style foreclosure crisis. But can we believe that? Is that going to be true? Do we want to bet with the Fed, or is it better to bet against the Fed? Well, let's think about that. We have two real choices here. Number one, wait. We wait and see what happens. And then number two, we'll go through these options here together, and then we'll talk about trends, okay? All right, so number one is wait. And when we wait, we can take our earnings and put them into cash, Bitcoin, stocks, or bonds. You know, bonds are kind of out of favor, and cash could be okay since inflation's going to be pretty low over the next couple years. Or we're seeing near zero inflation. Heck, Canada just went into a deflationary time, which we're expecting. I think our entire global economy is heading towards deflation, and that's why we see more money printing happening, right? But so cash bonds, let's put those aside for a second for consideration. You know, Bitcoin is something I think you'd really buy into if you're super anti the dollar, super anti the established system, so to speak, the government and the Fed. So that really leaves sitting in cash or stocks. And if you're thinking, you know, at some point I want to buy real estate, I want to get into maybe owning a duplex or a triplex or fourplex or investing in real estate, building my wealth. You know, Kevin, I like you say in your courses, I want to buy those below market value wedge deals, but I'm not quite sure if now's the time. Well, then you're really torn between cash and stocks. When we look at the stock market, we go, wow, not many opportunities left here. It's kind of like those have been swallowed up over the last 2 months. Last, March and April, a lot of the stock deals are kind of gone. And now we're paying what are called safety premiums in stocks. We're able to buy Amazon at these ridiculous prices, and for Amazon to hit new records almost every week because people are fleeing to safety, right? People are fleeing away from travel, and they still are. They're out of travel, they're worried about a second wave, they're out of hospitality, they're worried about commercial real estate. So, retail had a good day today, but there's still concern in retail and, even real estate investment trusts. So they're plowing money into these safer stocks, and we're seeing these premiums. Well, when you see a premium, you're basically, that's like a nice way of saying you're kind of overpaying for some stocks right now, right? And that might not be bad. It is a style of safety investing. And in the long run, paying a little bit of a premium now, not that big of a deal if it means you're on Train America, right? If you're buying stocks. If you're buying Bitcoin, you're not necessarily on Train America, but you're on your own train, and I'm not bagging on that train. You're just on a different train, okay? And cash, okay, that might give you some flexibility if you have the discipline to stay in cash and not spend it, fine. So that's choice number one. Choice number two, and then I'll come to a conclusion as to what I think. Choice number two is you get in the game. And if you're going to get in the game, here's the opportunity that you have right now. You have a saturated condo market. A lot of people are dumping condos and properties with small lot sizes because they're worried about the impacts of the stay-at-home culture and sort of the pandemic. They're thinking possibly in potentially a very overblown manner that people are going to want backyards. They're going to want a pool. And so we're seeing more interest in houses with yards and pools, not necessarily like large acreage, though I imagine that'll do well as well in certain areas of the country, but larger yards in favor of condos and community complexes. That's not so good if you own apartment buildings. But this is good if you are interested in being a buyer of apartment buildings or condos. And so then you ask yourself, well, I mean, wouldn't anybody rather buy like a duplex, triplex, or fourplex or an apartment building? Yeah, maybe. Both of these can be good opportunities for you to buy in, as well as our general opportunity to always buy fixer-uppers, right? Wedge deals. Generally, wedge deals are gonna be in the single family and the condo market, not so much in multifamily, unless you get rents way below market value. That's how you get good deals in multifamily. We'll talk about that obviously in detail in the course. But the most important thing to think here is, if you're going to get in, what's your job stability? Because as terrible as the unemployment numbers are, over 70% of us are still working. And if you look at your income now and say, okay, my income is X, why don't you take 10 to 20% off of your income in case your company introduces some sort of pay cuts? Well, if you have a pay cut, what can you then afford with a pay cut? And with a pay cut, are you going to be able to make your payments and be comfortable with the expenses for your property? Remember, PITI plus HOA, right? Principal, interest, property taxes, insurance, plus HOA dues. And then of course you want to set money aside, usually $200 a month for repairs if you're going to rent the property out, for reserves in case something comes up, right? Create a little bit of an emergency fund for your properties. It's different than an emergency fund for yourself. So these are your two choices, right? Either you wait on the sidelines and you sit in cash, or you go into stocks where you are paying a safety premium, or you're buying sort of the bottom feeder stocks. I get it. Like I bought some of these too, the Delta, the Carnival, the Simon Property Group, and you're kind of floating around at the bottom. Like there hasn't been a big move up, right? So these are sort of, or you're in like the Amazon, the Apple, the Tesla, which have sold for premiums now, even Peloton, a little bit of a premium, but good upside potential there. In fact, I personally think Peloton is gonna be cutting a lot of people out of the commission sales gig, and Peloton revenues are gonna go through the roof. So those are your stock cash plays. Or you get into real estate where you're looking for exhausted landlords, people who don't want to deal with apartment buildings anymore. You get into the saturated condo market where people are like dropping condos because maybe people don't want those anymore, or you're looking for fixers. Depending on your stability with your income and your interest in doing work on maybe a single family, it's an option for you. And if you're fearful, getting into a condo might be an interesting way to start, as long as the condo complexes don't have crazy restrictions like you're not allowed to rent it out or your HOA sucks, because HOAs can suck, management associations, they can suck. You get into a good association, the nice thing about a lot of condos is, depending on your association, a lot of them, you don't have to pay to maintain things like the walls, the roof, the sewer line, the structure, the building, the exterior paint, the exterior landscaping. So if you're thinking about like stay-at-home minimalism, you might be able to hop into some deals on condos, townhouses, and again, if you want to go for the big gusto and own the whole building, an apartment building or a fixer. But now, we've talked trends and we've got our options. So we know our options are either cash stocks or fixers, apartment buildings, condos. Now, what are we thinking about an actual foreclosure crisis? Well, let's analyze this. So in order for us to have a foreclosure crisis, after mortgage forbearance ends, we're going to basically have to see banks force people to catch up on their payments. But right now, there is already a substantial movement in Congress that says, no, it's okay. We'll just let you put your payments at the end of a loan. Okay, well, that takes away a massive amount of foreclosure pressure. Huge amount of foreclosure pressure gone. All right, well, what's the other option? Okay, well, in a year after mortgage forbearance is over, people don't have a job to go back to, or they get a job and they make 20 to 30% less money. Is this going to now force people into foreclosure? Well, let's consider this. And then this is my speculation, but I'm trying to put my thinking cap on. When America goes back to work, if somebody owns a house and they go back to work, and now all of a sudden they're house poor because they're making less money, are they going to sell? Possibly. They'll absolutely, quite possibly sell. But if prices start falling, say, 93% of Americans have more than 5% equity, so let's say prices fall 15% in the worst case scenario, which means the average person is upside down by about $20,000 to $30,000 in equity. Is it going to be worth somebody dumping their loss of about $20,000 to $30,000 in a house and then having a 7-year record of foreclosure on their credit report, limiting their opportunity to buy real estate in the future? Or are people going to suffer through the payments work more but be poor, which means less consumer spending, but still making their mortgage payment and not going into foreclosure and ruining themselves for the next 7 years. And so that is where I believe you have to make up your own mind. That is, if you believe there is going to be a foreclosure crisis, you are saying that when prices fall 15%, people are going to start listing their homes, even at a potential loss, to get out. Just to get out because they can't afford it anymore because their pay's gone down 20%. They're too house poor, they gotta get out. And then once we start seeing people sell for a loss, they start selling with short sales and we start seeing more foreclosures come up. Short sales are sort of the initial process of foreclosures, right? We start seeing that, then yeah, that could self-fulfill and we could see more of a decline, right? Could we see a 20, 25% decline? Maybe. But remember what the Fed is doing. They're pushing out guidelines regularly, and Congress is regularly saying, hey, you know what? If at the end of forbearance, people can't make the payment anymore because their income has declined, then we need to give them the option to modify that loan to avoid foreclosure. That is, you know what? Maybe let's lower how much principal you're paying off every month. Maybe let's turn your 30-year loan into a 40-year loan. And that goes back to what I said at the beginning of this video. The Federal Reserve is trying to prevent a financial crisis. People going through foreclosure and short sales freezes up banks, and that's what the Fed's trying to prevent. And the Fed is in the ear of Congress, and Congress is already saying, let's extend forbearance. Let's put the missed payments at the end. And you know what? As the bills say, if people can't make the payments at the end, then they may as well do a loan modification before they go into foreclosure and really push the market to crap. So remember, in my opinion, for us to actually see a foreclosure crisis, we'll have to see prices fall 15%, people's income go down 15 to 20%, people not be able to get loan modifications, be forced to sell, because people aren't gonna stay unemployed forever, right? They will go back to work, albeit at less money. And then all of a sudden, what happens? Well, your foreclosure crisis in that scenario doesn't happen, because the Fed and Congress prevent it from happening by giving people options. Let's just accordion out your loan longer and lower your payments. That's a more likely bet, in my opinion. I'll give you a percentage in my take. And so that's why personally I align with, hey, you know what? I'm pre-approved. I've got cash ready to go. I'm geared up and ready to take advantage of these low rates because I know there are going to be distressed condos, distressed apartment buildings, and distressed single families, and I'm gonna scoop them up. And you know what? Maybe people like me and people in my investing course link down below, and those of you who get your 2 free stocks with Webull when you deposit $100, you get 2 free stocks, link down below. And of course, those of you who get your life insurance because, you know, we're out there trying to buy real estate deals, may as well be protected with life insurance, or at least protect our family. Well, we're ready to go. We're ready to snatch up these deals. Now, does that mean I'm some shill trying to get you to buy real estate and that guaranteed there won't be a foreclosure crisis? No guarantee for that at all. I guess I just look at it this way. I think right now there's a lot of sentiment that says unemployment is so high, how can there not be a foreclosure crisis? And I think in that aspect, we look at sort of this roulette wheel at a casino and we're like, okay, foreclosure crisis is red, no foreclosure crisis is black. Go place your bet. You got a 49% chance of that, 49% chance of that, and 2% chance that Bitcoin wins, right? So that's kind of what the roulette, Bitcoin joke, okay? I'm not trying to offend Bitcoin people. That's kind of the roulette wheel right now is what it feels like. But the reality to me is I got 90% of the table covered. I got 90% of the numbers on the table covered. And there's maybe a 10% chance of a severe foreclosure crisis. Not because of unemployment. Look, unemployment is bad. Solely because of what the Fed is saying about what I just described and what Congress is doing. If those things change, and if they say, you know what, screw forbearance, y'all just go through foreclosure. You know what, file BK. Yes, that will be bad. Then the stacks will change. That's gonna be kind of like Jerome Powell coming up to my roulette table and going, those chips, mine, and takes them off the table and goes and plays craps. That would be bad. Then we got problems. So there you go, folks. This is my opinion on the coming foreclosure, pandemic, crisis, coronavirus, whatever. And folks, make sure you get those 2 free stocks with Webull. Get your life insurance. Join me in those programs down below. Thank you so much for watching, and until next time.